States revolt against Biden's fee hikes over people's great credit. Next. We are going after the entire administration. Yes, we're not going to stop at Biden in the states. We're also going to go after Janet Yellen and what she's done to really help our economy out. And where do we see the light at the end of the tunnel? Which there is a light in the tunnel that we're going to go over next on Real Estate Daily. Welcome, everyone. My name is Troy, and every day we go over the latest news in real estate, mortgage, and the housing market and what affects those things, because macro is definitely affecting. Now, if you're out there and you're a buyer or a seller, one of the two, go down below, hit the link, then put in your email address, and you're going to get sent either a buyer's guide. It's going to go over each step of the way of how to purchase a home from the very front. First thing you need to do is get pre-approved and see how much your monthly mortgage payments are, all the way through escrow and how I get my keys, and then I pop the champagne bottles, open the front door, and I am a homeowner. On the seller side, how do I sell a home? How do I pick the right agent? You know, what does the agent even pick? Is their phone up? There's so much going on. You know, how do I get a seller net sheet, all the way to how do I market my house, right? The right way, as well as escrow, and then selling my house and getting that big fat check, hopefully, you know, in your hands of what you netted from that property. That is below us. Yeah, hit those links, definitely. Now let's jump right into it. This is from CNBC. It says states revolt against Biden's disaster mortgage distribution rule to subsidize risky loans. Guys, this is probably one of the biggest, you know, I mean, in the mortgage industry, I mean, I think there's a lot of other bigger issues that this administration has really blundered, but this is another blunder. Now, they're blaming Biden, but really what it is, as usual, is a Biden appointee that doesn't really qualify for the job and has been put in it for possibly other reasons, but just doesn't understand what implications it has. If you, as a politician, are looking to maybe help the underserved, well, what is the biggest loan programs the underserved use? Not what you want to go do and beat your chest and say what's great. So with that being said, we're looking at conventional loans. Conventional loans are typical loans that people put minimum of 5%, but mostly 10, 15, 20% or even more down on their house. And so the head of the FHFA, Sandra Thompson, in her infinite wisdom, has said that anyone that's putting down 5, 10, 15, 20%, let's go ahead, and if you have a higher FICO above 680, we are going to penalize you for doing the right thing. So with that being said, that is now is kind of translated to Biden because it's just an appointee of his. And now 27 states are saying, no, we're not here to go and make people that have lower credit, risky credit, the credit that caused, and the loan programs that caused the 2008, 2009 housing crash and then substantial recession. We don't want to be in that situation again. Maybe you're trying to put a recession together, Mr. Biden, Mr. B, but yeah, we're not. And so you need to go reassess what you're doing here. Now, if I take a step back, I'm going to say it again. Okay, we're looking at people that put down, I don't know, 5, 10, 15, 20%. Now, if the people that don't have very good credit and or have very little down payment, what do? They go to FHA. It's a whole different loan program. That's where the majority of those people are, FHA. Now, we don't understand why you would think that riskier, lower FICO people would be using FHFA and conventional loans. Doesn't make any sense to us. This just looks like we're penalizing people that absolutely are running, are the strong part of our economy, the strong middle class that are trying to buy homes, that saved up their money for it, made sure they made their payments on time, and then I'm gonna penalize them. And then the people that not quite made their payments, been behind a little bit, maybe had a repo here or there, threw a bankruptcy in so they can get out of things. We're going to go ahead and give them better terms. And this is the joke that everyone's talking about. And now the states are just done with them. Again, you're just constantly being sued for this, for that, all these things. We're just seeing in my eyes, the dismantle of the United States and its wealth and strength here. This is just not a very, very good program, and it doesn't help anybody. So, all right, before we jump into the next one, guys, hit that subscribe button. If you like the content, boom, hit it. I give my opinions on a daily basis. None of it really makes sense. Now, we're going to go listen to Dr. Peter St. Onge here. He is he goes over politics, and I kind of like the way he does it. The first time, a couple times I heard him, I thought he was one side or the other, but I really like that he goes right down the middle. I don't think he leans left. I don't think he leans right. He just leans the truth. And I know it's very hard that a lot of you media people out there, you listen to news on channel 247, whatever, here in Southern California, that's all being slanted. Here, Dr. Onge kind of puts it right into a little ball of wax, and then I'm going to go over what the light of the end of the tunnel is for us. First was Biden. Now we're going to see Janet Yellen and what he thinks of her.
Bank crashes are back. Just 5 weeks ago, Janet Yellen gave a speech amid fears of regional banks collapsing, where she said, quote, "The situation is stabilizing and the U.S. banking system remains sound." The New York Post characterized it as, quote, "drooling happy talk." And yes, it turns out Janet lied. Yesterday, the FDIC said it will take over one of the largest regional banks in America in preparation for a bailout, followed by a fire sale to a mega bank. For those following along at home, this makes 5 major banks vanished in 50 days: Silicon Valley Bank, Silvergate, Signature, Credit Suisse, and now First Republic. So what happened to First Republic? Well, they're going through a concentrated version of what all U.S. banks are going through: reckless Fed hikes that gutted their bond portfolios while driving businesses to bankruptcy.
So I really like what he has to say here. It's kind of right to the point. We continue to see the craziness that's gone on since 2021 and the administration coming in. First year they get in, they say, oh, the world's collapsing because of the beer flu. And then they turn around and they recklessly spend trillions upon trillions of dollars. And then the Fed turns around and prints $9 trillion like a drunken sailor. Let's just go, I'm just gonna go burn all my money. I'm gonna spend like out of control. I'm going to every whorehouse, whatever, right? And then all of a sudden they wake up and it's the end of 2021, and I'm like, oh, I'm broke. And things aren't as crazy as I'm not receiving all this money. So the Fed then goes from it's transitory to, oh shit moment, we need to go raise rates. So we went from the absolute best of times to what, 2%, 2.5%, maybe 3% interest rates, to drunken sailorness, wake up call, hangover. Oh my God, I got to get my shit together. I got to get my life back on track. They just pump 500 basis points in 1 year into the market and then destroys everything, right? It's a wrecking ball. What happens is everything goes up, gas goes up, energy goes up. Energy's through the roof, right? We're looking at food going through the roof. Guys, why are we electing the same idiots that spent all this money, got all of us broke, and then they turn around and they say they have a solution? They don't. So now they're doing the wrecking ball, and the next sector this year has been the banking and financial sector, and that's the wrecking ball. So the Fed now is going to meet this week and next 2 days, right? And we're going to find out whether they're going to raise rates. Well, odds are they're going to put 25 basis points. Okay, they're going to raise 25 basis points, which every European country and the BRICS alliance, BRICS, right? Brazil, Russia, India, China, and South Africa, who are now having 25 other countries want to join them and be done with the dollar. They're saying you're destroying the world by utilizing the dollar as the world currency. You're destroying it by raising rates, and you're hurting all countries besides European countries, the whole world. But of course, just like the Fed, who now is the drunken sailor, right? Who now is rolling out of bed, going, I'm fixing my life, and I don't care at anyone's expense, right? And that's what's happening. Now, why I talk about this has nothing to do with politics. This has to do with what's going to happen with the rates. Yes, do we see rates going up in the near term? Possibly, or they stay flat. But just in a rate hike tightening cycle, what do you usually see? I showed this about 6 to 9 months ago, or 6 months ago. Every time the Fed has done this, historically over the last 7 times, when the Fed pivots, okay, they stop or they pivot, you see that all the stock market and the euphoria comes out. Oh, we stopped and we're gonna go down and let's go party. We're back to drunken sailor person. We didn't learn our lessons. What does the historic data show us? The Fed's tightening is typically 6 to 9 months later before we see it actually happen. Think about that. The Fed started tightening in March of last year. We're just starting to see the effects of it in January of the next year. That's why we're seeing the banking crisis happening. That if we pivot and then even go down, we're going to have so much unemployment. We're going to have so much of all these companies that have been laying off. They're now, what are they going to do? They're going to go to the Fed window, take a walk over. They're going to say, I want to borrow money at 1%, and I'm going to get AI technology, and I'm going to turn around and lose jobs. But for people who have jobs that are non-replaceable, and there's a lot of you out there, we see that Fed rate hike go flat and then go straight down, people. And so my prediction, by January of 2024, the election year, we're going to see rates in the 4s. Okay, we're in the 6s and 5s today. We're going to see rates in the 4. There is a light at the end of the tunnel. Let the wrecking balls be wrecking balls, right? Let them do what they do, because they will be the first ones to say everything is going to be great. And look what we did. We're the savior of the economy. We blew it. Then we destroyed it. Then we have the solution for it, and they're going to beat their chest. And by God, it will help out this housing market in the 4th quarter of this year and in the 1st quarter of next year, 1st and 2nd quarter next year. We're going to see the housing market hit that boom again, because people will be able to afford. The rates will come down, and we'll see more buyers hit the market and get back into it. So that's why I played this. I want to show that we need to go through this little cycle to get to where we need to be, especially you guys who bought homes at 6s to get them down to 4%. All right, next one. Who bailed out? Who bailed out First Republic? So First Republic came in. Again, people pulling money out, their stock goes to nothing, just gets crashed down. Then the Fed turns around and the Treasury turns around and just tries to sell it off, right? They've already done it once. They try to sell it off. Well, they can't. So the FDIC comes in, takes over possession, jumps in and puts, I think, $30 billion into it. The Fed throws in $13 billion in. So the FDIC money is sitting in an account. They've already collected that money, and so that doesn't affect us. But the Fed putting $13 billion into it, that affects us directly. That, again, causes inflation. And then they turn around and they sold to the highest bidder for, $10 billion? It was something ridiculously low, right? All of its assets and all of its clients to JP Morgan Chase. And so again, another one bites the dust, and this is gonna be a domino effect for all these regional banks that aren't equipped for all the defaults that are coming because of the Fed tightening. And with that being said, we're going to see, again, rates, I believe, are falling somewhere in the next six to 9 months, even 12 months from now. All right, let's jump into the rates. What are the rates? Well, looks like 30-year conforming on Friday were flat, 6.44. We did see FHA go down 3 basis points at 6.38. We saw a big fall in jumbo, down 16 basis points. But what happened to 15-year? A much safer, haven for some of these banks. Why all of a sudden now went up 18 basis points? There must be some defaults there that's going on. We're just seeing this crazy roller coaster ride on rates right now. I think that somewhere, again, in 9 months, they'll stable out and we're going to see much better rates and a better refi environment. Well, guys, thank you very much for joining me today. I really appreciate it. I'm looking forward to giving you the best news Monday through Friday. If I'm not here, we have producer Emmy that's going to go over it, or my business partner, Ryan. You guys have a fantastic day, and I will see you tomorrow.